Okay, class. Good evening, class. You're welcome to another class on financial reporting. Today, we would finish up on IAS 12 and we would immediately commence IAS 37. I remember vividly where we stopped on income taxes. I gave you this question as assignments for you to solve it. So some of you have solved it anyways, but let's just quickly do the corrections together. Then we'll move on to IAS 37 on provisions. Now, if you look at this question, let me go to this part of the question. That's said, Bugan Nigeria Limited had an accounting profit before tax of 196.8 million for the year ended September 30th, 2022. Now, so the following balances were extracted from the company's books as at September 30th, 2022. They give us some assets, non-current, current assets, and current liabilities. And they give us some other information. First, they told us interest income is taxed, while interest expense is allowed on a cash basis. And we're told that there were no opening balances on interest receivable and interest payable. Additionally, we're told that the trade receivables above is shown net of allowance for doubtful balance of 116.75. And they said this is the first year that such an allowance has been recognized. The deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up. Number three, we're told that the balances in respect of office equipment are after charging accounting depreciation of 28.25 and tax allowable depreciation of 22.5 respectively. Then we're told that the freehold property was purchased on October 1st, 2021 for 263 million and is being depreciated for accounting purposes on 10% per annum. And we're told that Bugan Nigeria Limited is in a position to claim 94.6 as accelerated depreciation on cost as taxable expense in the year's tax computation. We're now required to prepare a tax computation to calculate current tax expense. We're also required to calculate deferred tax liability as at September 30, 2022. I'm also required to show the movement on deferred tax account for the year ended September 30, 2022, given that the opening balance was 18.1 million, like that. Okay. So given this correction, you are asked to do the tax computation and compute the current tax expense. So if you want to do the tax computation, or let me call it determination of current tax expense, you would usually start from your PBT, your profit before tax, or your accounting profits, which year is 196,800. So let's put this in perspective. So we'll have profits before tax, which is 196,800. We'll add back disallowable expenses. And what are the disallowable expenses you can have? From these notes, we can get all of them. The first part here told us that interest income is taxed while interest expenses are liable on a cash basis. There were no opening balance on interest receivable and interest payable. So this note one is telling me that my interest income and interest expense, they are taxed or allowed on a cash basis. So meaning that the taxman is not going to capture them this year. He will capture them when the cash impact occurs. And they also told me that there is no opening balance for interest receivable and payable. So which means that this interest receivable you're seeing here and this interest payable you are seeing here occurred this year for the first time. So which means that when they say interest income, that means it's talking about this interest receivable because we have not received it. It's still receivable. So the two legs is one goes to interest income, the other is receivable in the balance sheet in similar financial position. While this interest expense is exactly the same thing as this because it's happening for the first time. That means the corresponding debits for this interest payable is in the P&L like that. So that's what they mean by no opening or closing for the year. So it's just happening this year for the first time. However, here, this is an expense. Since it's going to be allowed on a cash basis, it means that the taxman is going to disallow it this year. And this interest income, they will exempt it from income this year. But we'll get there. Let's deal with this one that they will disallow this year, since it's going to be allowable on a cash basis. So the interest expense, how much is it? 10,850. 10,850. The second one is talking about trade receivables. Now, this trade receivables is shown net of allowance for doubtful debt of 16,750, meaning that the trade receivables you are seeing here is after removal of allowance for receivables of 16,750. They have removed it already. Okay. And this is the first year of such an allowance that this allowance has been recognized. So they are telling you this just for you to know that this 16,750 is also the amount that is recognized to P&L. Because that's the two leg for allowance for receivables. You debit P&L, you credit an allowance for receivable account that you go and net off against receivables. So it is also this 16,750 that is in P&L. And they said that a deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up, which means that the tax authority is not going to allow this amount as a deduction. It will only allow it as a deduction when the debtor is winding up. So this allowance for doubtful debt you have made is not going to fly. They will disallow it. So we'll have allowance for doubtful debts of 16,750 of 16,750 as allowance for doubtful debts. They will disallow it because they only allow it when the debtor is winding up. In note 3, they talk about an office equipment that the balance in respect of office equipment is after charging accounting depreciation and also tax allowable depreciation. This 28,250 accounting depreciation will also be disallowed. So we have depreciation 28, is it 250 or 850? 250 will be disallowed for tax purposes. And also, freehold property is being depreciated for accounting purposes on 10% per annum. So 10% of 263 million, that will be 26,300. So another depreciation. In fact, why don't you help me add these two together? If you add it together, what will it give us? Any student that can help.
54,550. 54,550.
50.
64,
54, 54.
64, 550.
54, yeah.
Is it correct?
Yes.
Okay. All right. So that's depreciation. Is that all? Yes, all for our notes, but there is a fine payable here. Fine are usually disallowed. They are not allowed for tax purposes, so I have to disallow this 32,500. $32,500. So can you add all these disallowables together and get me a figure?
$114,650.
Okay. Then you also deduct exempt income. And the only exempt income I can see here is the interest income. Is the interest income here. And how much is the interest income? This amount here,
3,250.
3,250. That's 3,250. So we don't have any other exempt income here except that. So can you do 196,800 plus this minus this? What would that give us?
308,200.
308,200. 308,200. What do we call this amount?
Accessible
That's
profit.
what we call accessible profit. Then by the time you deduct your capital allowance, and from here, I have 22,500 here for capital allowance, 22,500 for capital allowance, and I also have what again for capital allowance? For this field property, Buga Limited is a position for an accelerated capital allowance as taxable. Okay, the position on cost as taxable expense. So 94,600 also as capital allowance. Can you add these two together?
$117,100.
117,100. So what's my taxable profit?
$191,100.
191,900. My current tax expense. They give us the tax rate in this question. They didn't give us, but for a large company, the tax rate is 30%. So how much does that give us?
57,330.
57,330.
330.
And we are done with the requirements. One, that requires us to do the current tax expense. The second one asks us to determine the deferred tax liability as at the end of the year. So that's the second part of this question. It wants us to determine the deferred tax liability as at September 2022. Now, to do the deferred tax as at the end of this year, we will need to determine the temporary difference. When we determine temporary difference, then deferred tax is just a percentage of that, 30% of that. So how do we get temporary difference? We simply compare carrying amounts with tax base. That gives us our what? That gives us our temporary difference. Like most immediately. Okay, so let's go to my statement of financial position, starting with the freehold property. Freehold property. What's the carrying amount of the freehold property? Is the figure on the face of the account.
236,700.
236,700. What's the figure for the tax base? For the freehold property, if I go to the notes for the freehold property, I was given the costs as 263, and I was given the capital allowance as 94,600. So if I simply do that 263,000 minus 94,600, what would that give you? 168.
400.
400. So what's the difference between the two? What's the difference between the two?
68,300.
68,300. Is this a deductible temporary difference or a taxable temporary difference?
The taxable temporary difference.
Okay, let's put all the taxable temporary difference in brackets. So it is a taxable temporary difference because our deductions are lower. So it's taxable. The next item here is office equipment. So if I copy and paste this here, what's the carrying amount? The carrying amount is this 205,000 because they told me that it's after deducting depreciation in these workings here. So the balance in respect of every agreement is after deducting accounting depreciation of this. So the carrying amount is this amount. The tax base should be the cost minus the capital allowance. So, but I don't know the cost now. The only way I can get the cost is to add back that depreciation that they have deducted to derive this. So if I do it as my workings here, that the cost of the office equipment is that 205,000 plus 28,250. 205,000. You're adding this 205,000. I'm adding back the depreciation that they have deducted before, so I can derive my costs. So what would that give us?
$233,250.
Then the tax base of that office equipment will be that 233,250 minus the capital allowance. What's the capital allowance? 22,500. How much are we looking at?
210,750.
210,750. Okay. So what's the difference here? Sorry?
750.
4,750.
No, 5.
570.
Okay. Is this a deductible temporary difference or taxable temporary difference?
The deductible temporary difference.
Yes, it is because our deduction is higher. Okay, that's correct.
So
So
please, I'm not clear on that, please.
yeah, it is a deductible temporary difference because our deductions are higher. We will get higher deductions. That's the reason. So since this one is in jackets, and we said this is taxable, you will see that this one is taxable temporary difference because we will be getting a lower deduction in the future. That is the meaning of tax base. The deductions you will get from the tax authority. Since it's lower, we said this is taxable. Put it in bracket. Since now, for office equipment, the deductions we will get from the tax authority is higher. So this excess is a deductible temporary difference. So let's do the reverse by not putting that one in jacket. What's the next assets? We have done this, we have done this. The next one is trade receivables. Trade receivables. And the carrying amount of the trade receivables is 174,250. It's 174,250. But what's the tax base? What's the tax base of the trade receivable? It's going to be 174,250 plus, because I was told here that the trade receivable is shown net of this 16,750. So which means that they have already removed the allowance for doubtful debt. And they told me that the taxman is not going to allow it for deduction. He won't allow it. So for the taxman, is going to add it back. He will not allow allowance for receivables. So how much is, and you add the two together, what do you have? Sorry?
191,000.
191,000. So we have 191,000. The temporary difference should be this 16,750, and it's going to be a deductible temporary difference because we're having an higher deductions here. We're having a higher deduction, or since they will allow it, the tax authority will allow it in the future, so we can also judge it as a deductible temporary difference from that perspective for the trade receivables. So we would also put that one too, we'll naked it. The next assets after trade receivables is interest receivable. Interest receivable. Interest receivable. And that's the carrying amount, the figure on the books. The tax base, what's the tax base? They said interest income is taxed on the cash basis. That means the taxman is not going to capture it. He's not going to capture it this year. He will capture it when we receive it. So as far as this interest receivable is concerned, the tax base is zero because taxman is not going to capture it. So the temporary difference is 3,250. And it's going to be a taxable difference because it's to be taxed in the future. To be taxed in the future. So we have a
Excuse me,
taxable
sir.
difference.
Yeah, please
Yeah.
check the statement again.
Which one?
The note on interest receivable. Check it again, sir.
Okay. They said interest income is taxed while interest expense is allowed on a cash basis. So interest income is going to be taxed on the cash basis. Interest expense is also going to be taxed on the cash basis. So my concern now is the interest expense. Interest income is to be taxed on the cash basis. So the taxman is not going to capture it this year, but he will capture it when we actually receive it. So the tax base now is zero. Tax base is zero. So since the temporary difference is 3,250, that means we are going to be, it will be taxed in the future. So we have a taxable temporary difference. Put that in jacket. The next item here is fines payable. Fines payable. So the carrying amount is 32,500. Fines are usually a disallowable expense. So it's never captured, never ever. And the temporary difference also will be zero, since it's a permanent difference. It's a permanent, you don't have temporary difference here. The difference is permanent. So it has no tax consequence. The next item here is interest payable. Interest payable. That's the next item here. And the carrying amount is 10,250. However, the tax base, since I'm told that interest expense is allowed on a cash basis, which means that the taxman is not going to capture it until it is paid. So that means the interest expense also will be nil, zero. So the temporary difference here is 10,850. And since it's going to be deductible in the future, it's going to be a deductible temporary difference. So I will leave it naked, treating it in the opposite way of taxable. So those are all my temporary differences. Those are all my temporary differences. So let's cumulate all this temporary difference together, and let's see if it's going to give me either a deductible or taxable temporary difference cumulatively. So you can just say this plus this. You then do this plus this again and get the difference. Let's see which is higher, whether it's the one in jackets or the one that is naked. Please let your calculator start working.
The taxable is higher.
Sorry?
The one in jacket is higher. The taxable is higher.
Okay, by how much?
When I put the two was 71,550.
3,800.
Eh?
1,550 for the temporary the taxable difference.
Which me, I can't hear you. Can
It said summation of
Sir, the, di-
300 71,550.
sir, the difference is 49,050 naira.
Okay.
The difference is 38,200.
Yes, that's it. Okay.
That's the correct answer. 3,800 is the correct answer.
Now, see where this is coming from.
All right. So that means we're having a taxable temporary difference. As 3,800. So taxable temporary difference will result in a deferred tax liability, which is 30% times 3,800. What would that give us?
11,450.
Sorry?
11,450.
11,450.
460, 460, 60.
460. Thank you. Okay. So we have determined the second part. The third part of the question is asking for movements in deferred tax accounts. So movements in deferred tax accounts. We just need to do, what's my opening deferred tax liability? I think they give us the opening. Yes, they give us opening. The opening balance of the deferred tax is 8,100. The closing deferred tax liability would be 38,200. So the difference will be an increase in deferred tax, which goes to P&L as an addition. Can call it deferred tax charge. The POL. So what's the difference?
3,100.
30. No, what am I doing? Deferred tax is 11,460. I was speaking temporary difference. So how much was the difference now?
3,360.
Okay, that's the end of this question. 3,360. That's the end of this question. So for those of you that have attempted it, this is the correction. This is the correction for you. And
So Abis, can we take pictures? A minute.
can take pictures, but why do that? When I will still share it on the group, I usually share this. This is the equivalent of me writing on the board in a physical class.
Okay. Okay.
Since I know you don't have that luxury to be writing from the screen, so I would usually share these working notes to you.
Okay, I'm not on the group yet.
Oh, okay. All right. You need to be there. Now, I need to mention something as a final note here. So note that deferred tax assets can only be recognized where there will be a future taxable profits. Future taxable profits against which the deductible temporary difference can be utilized. A company with a history of loss making is said not to have a future taxable profit. Now, what this note is telling you is that before you can recognize a deferred tax asset for whatever reason, we must be able to reliably estimate that this company will have a future taxable profit against which the deductible temporary difference can be utilized. You need to be able to show that. And the judgment we make in practice is that if we see a company that has an history of loss making, or we prepare our account this year and we see that this company made a taxable loss, we won't recognize deferred tax in respect of that kind of company, because that means it has a history of loss making. We won't recognize deferred tax for it. So any company that has a history of loss making, we do not recognize deferred tax for such a company. And that marks the end of IAS 12 on income tax. If you don't have any questions, I guess we can proceed to IAS 37. IAS 37. Okay, you're welcome to a new topic, IAS 37, provisions, contingent liabilities, and contingent assets. These three items here deals with different items because provision, contingent liabilities, and contingent assets are not the same. They're actually different. So we need to establish what they mean and, of course, understand other things around them. But at the end of this class, right, what the standard really wants you to know is to determine how to recognize, measure, and disclose provisions, contingent liabilities, and contingent assets. So really, that's basically what we want to ensure that you know. How do you recognize, how do you measure, and also how to disclose all these three items. So going straight to the business, knowing fully well that these three items are not the same, then what is provision? You see, according to IAS 37, provision is a liability of uncertain timing and amount. So a provision is a liability of uncertain timing and amount. So we are saying that there is a liability somewhere, and this liability, we don't know when we will pay it. The timing is uncertain. We don't know when. The amount, we also don't know it with certainty. It's uncertain. We don't know it. So it is a liability of uncertain timing and amount. Then, it then requires a lot of care and judgment to determine how to put it in your books. So it's a real issue for us accountants. And it's really a loophole. It's a loophole, which you would understand better as we move on. But for now, it's a liability, the time is uncertain, the amount is uncertain. If the time and amount is uncertain, then at what point do we recognize it? Abi, we don't know when. So at what point do you recognize it? How much are you going to recognize? So those are the roadblocks that we need to open up. We need to free before we finish this class today. Before I go into all of that, let me mention to you that provision is different from trade payables and accruals because for these two liabilities, because these other liabilities have a certain timing and amount. So for these other two, we know the timing, we know when we are supposed to pay it, we know the amount for these other two. That's how provision is different from these other liabilities. So again, let's trickle down to trade payables and accruals. Are they the same? Can anyone tell me the difference between trade payables and accruals? Is there any difference between the two? Anybody? Trade payables and accruals. So trade payables is an amount owed in respect of purchases of goods and services from a counterparty or a supplier on credit, and which the entity has received an invoice from the supplier. So we have actually received an invoice from the supplier. So that's a trade payables. We bought goods on credit. We enjoyed service on credit, and we have gotten an invoice. Those are trade payables or other payables. You see accruals. So this one is an amount owed in respect of goods or services from a supplier on credit, and which the entity has not received an invoice from the supplier. That's the major difference between the two. Is around receipt of invoice. It's just like you used an electricity bill for the month and you have not received an invoice from your provider. That's an accrued electricity bill. Or you owe staff salaries. Those ones will never give you invoice anyway. We refer to those as accrued salaries. So those are accruals. You don't get to get invoice on them, or you haven't received invoices on them. So we refer to those as accruals. I just needed to mention that just for your knowledge. Now back to provisions. Remember, we mentioned that provision is a liability of uncertain timing amounts. Then, if the amount and time is uncertain, then how do we recognize it? The standard then say that you can recognize a provision if these three criteria are present. Number one, it says that where it says there must be a present obligation as a result of past events. There has to be a present obligation as a result of past event. You see, this present they have here is not for decoration. It actually means present. It means that the obligation must exist. That obligating event must exist. It must be as a result of past event. If you have plans to do something, if you have plans to pay some money, that is not an obligation. You can never recognize a provision in respect of that. The obligation must be present. It must arise as a result of past event. Number two, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Number two is saying that it has to be probable that there will be an outflow of resources. It has to be probable that you will pay money. And when we say probable means that it is most likely than not. It's most likely going to happen than it not happening. That is a probability of over 50% here. So the likelihood of its occurrence is higher. That's probable. So it's probable that you will pay money. And number three, the obligation can be measured reliably. So we can measure the obligation reliably. That's the third recognition criteria. These three you must know. These three you must always remember. They will always ask you. And from your past questions, it has always been very simple questions for you regarding provision, but I'm going to prepare you fully in case they decide to blow out in a diet. So we'll look at more complicated questions for you to practice with. Now, these are the criteria that has to be present before you can recognize a provision. This is what determines the time, even though the timing is uncertain. But with this, if you look at for these three, then it would inform you of when you're supposed to recognize it in your books. And these three must be present, all of them. If all are not present, then you cannot recognize it as a provision. You are probably going to recognize it as something else. Definitely not a provision. But if these three are present, then of course you will be able to recognize it as a provision. Okay, so we have cleared recognition of provision. Now let's use some questions to practice.
Hello, sir.
Yes, sir.
Sorry, please, I don't understand probably this number two, please. Could you just explain it again? I'm really confused about it. Thank you, sir.
Okay, so when we say probable, for your exams, the examiner will give you a probability of above 50%. So that's probable. But what it means that the likelihood of it happening is very high. The likelihood that you will pay money is very high. And the standard says it means most likely than not. Meaning it's most likely that you're going to pay than you not paying. Okay, it's probable. That's what probable means. Meaning it's under probability. We are not 100% certain. We're not 100%, but it's probable. Meaning more likely than not. The likelihood is higher. Is above 50%, something like that.
So we can just assume that we will definitely pay.
I didn't say that. I said above.
You said above 50, yes. Okay.
Yeah.
Thank you, sir.
You're welcome. Okay, now if you look at this question, it says that a company is planning a reorganization. They now said these plans are in an early stage. Can the company create a provision for the reorganization? So for this one, the company cannot create a provision for the reorganization because there is no present obligation. There is no present obligation. Where is the obligation? I can't see any obligating event. They are just planning a reorganization, which is okay. They can plan whatever reorganization they want to plan. But we don't have a present obligation here. So for that reason, they cannot recognize or create a provision for the reorganization costs because they're just planning. So they cannot create a provision. So, and immediately it doesn't meet this one. Every other one is, because it has to meet everything. So since this one is gone, every other one is just, don't bother looking for that. Okay. So let's look at the second question. It says the Prince Properties owns a series of high-rise modern office blocks in several major cities in Nigeria. The government introduces legislation that requires toughened safety glass to be fitted in all windows on floors above the ground floor. The legislation only applies initially to new buildings, but all buildings will have to comply within 5 years. Can the company recognize a provision? Who can try this one? Nobody? So, again, the Prince Properties cannot recognize a provision because there is no present obligation. Look at it. They say this guy owns high-rise building, and the government introduced a legislation that requires toughened safety glass to be fitted in all windows on floors above the ground floor. So the legislation applies to new buildings, but all buildings will have to comply within 5 years. Can the company recognize the provision? Yes, this company, they have an obligation. They have an obligation, but this obligation is not present. It's not present because apparently they didn't tell us that they have any new building because the legislation applies initially to new building, but all buildings will have to comply within 5 years. So this guy has 5 years to comply. That means there is no obligation now because he can decide to sell the building maybe in the next 1 or 2 years. And when we say obligation is your duty to act in a certain manner in which the entity has no practical ability to avoid. You cannot avoid an obligation. Obligation is not something you should not be able to avoid it. Before we can call an item an obligation, the entity must not be able to avoid that obligation. So this guy can avoid this obligation. So it is not even an obligation. So the prince cannot recognize the provision because there is no present obligation. I mean, the entity can decide to sell the buildings in few years, thereby avoiding any obligation. There's no obligation. And I need to mention this again. This point one, this present obligation. You need to know that this obligation, it can be either legal obligation, where that's what you are required to do. It is required by the law of the land. The law requires that you must do it. And it can also be a constructive obligation, saying that the present obligation can either be or can either arise from a legal obligation or a constructive obligation. So if it is a constructive obligation, that one arises where, as a result of an entity's past practices, an entity's published statements and policies, that it has created a valid expectation in the mind of people, of stakeholders, that is going to act in a certain manner or that is going to do something. I mean, it's something he has always done. He has mentioned, communicated it publicly. He has written it that he would do something. That's a constructive obligation. It is an obligation because you cannot avoid it. It will affect your reputation as an organization. So you should know that also exists. It's not just about legal. It could be constructive obligation. Could be constructive obligation. Okay. So I haven't mentioned that. For this one, the prince cannot create a provision. It does not have a present. It can avoid it. It can decide not to sell the building and everything is over. It's over. Now, the third one, this talks about Lugard Limited. Says he operates in a country where there is no environmental legislation. Now says that its operation cause pollution in the country. Lugard Limited has a widely published policy in which it undertakes to clean up all contamination that it causes, and it has a record of honoring this published policy. Is there a provision? Who can attend this? Is there
Yes.
a provision?
Yes, there's a provision. There is no provision. There's a provision.
There is no provision, sir.
No provision. There's provision.
No provision.
No
There is a
legislation.
provision, sir.
There's
There is a
provision.
there is a provision because the company has a published policy, and also we part with there's a financial implication too. We can't hear you again. No. Hello, sir. We can't hear you. Please, from my end.
We can't also hear you too.
Okay, sorry, I was muted. So yeah, there is a provision here. There is a provision because the entity has a widely published policy to clean up all contamination. So it has a constructive obligation. So it has to make a provision just because he has a widely published policy. But note that the other two criteria must also be met. The other two, the remaining two criteria
It has all.
must be seen to be achieved or met, must be seen to be met before a provision can be recognized. And here now, they didn't really tell us, we don't have the full detail here. I just need you to understand that present obligation. That's the key thing, that the others won't be so difficult for you in the exam for this one. Okay, so our conclusion is here, we make a provision. Okay, I can see
I
and
have a question, sir.
all right, you can ask.
Sir, this first line, what if, since there is no environmental legislation in the country where he operates, what if he chooses not to?
I mean, good for him. It destroys his image as an organization. If he's ready to do that, if he's ready to damage his goodwill, she go ahead. Don't forget, goodwill is an asset that is recognized in the consolidated financial statement. So yes, we agree there is no environmental legislation showing that there is no legal obligation, but obligation is beyond legal. There is also constructive. So from the standpoint of that constructive obligation, yes, there is a present obligation. So most entities don't joke with their image. They don't joke with it. I mean, people have public relations department just to show the companies in a good light, not to now say he made
Sir.
a widely, yeah, I'm sorry, I'm coming. He made a widely published policy, and they were told that he has a record of honoring this published policy, so he won't decide not to do it. Okay, you can go ahead now. Hello, Zoop, you can go ahead. Okay, I think his network is fluctuating. Let's go to the next question, please. This one says that Alibaba Limited gives warranties at the time of sale to purchasers of its products. Under the terms of the sale contracts, the company undertakes to make good any manufacturing defects that become apparent within 3 years from the date of sale. In the period it has sold to 50,000 appliances, and estimates about 2% will prove faulty. Will Alibaba recognize a provision? Can we attempt this? So, Alibaba will recognize a provision here because there is present obligation as a result of the sales contract. And it is probable that an outflow of resources will be required to settle the obligation. And the obligation can be measured reliably. So this guy will recognize the provision here. For now, the most important thing is the fact that he gives warranty to its customers, and there's a sales contract that says that he will make good any defect. So there's a legal obligation present, and he has already sold. So and he has estimated that 2% will prove faulty. So we will likely pay, and we should be able to estimate um, the future expenditure it will incur. Okay, let's do one more, the final one.
Okay, sir. Before we do another one, sir. Now,
Okay.
I was thinking that the probability will have to be like above 50% before we can make provision for yes, recognize the provision. Since this one is just 2%, that there is likelihood of their electronics or product to be faulty. Should we still go ahead and recognize provision?
Oh,
Thank you.
yes. You are going to go ahead and recognize provision. So the 2% here is actually talking about the percentage of the appliances that will prove faulty. It's not talking about whether we will pay or not, whether we will not pay. The probability we're talking about there is, are we going to pay? Are we not going to pay? That it should be more likely than not that we will pay money. Okay, this 2% here is talking about, he estimated that about 2% will prove faulty. Now, out of these 250,000 appliances, so 2% of them will prove faulty, will be faulty, right? So that one is a different ball game from that. Are we going to pay money? Are we not going to pay money? Yeah. So yeah, since even if there is 0.01% will prove faulty, it means we'll pay money. It means we'll pay. So for that is a different thing. So the probability of paying is different from how much or the quantity that would be bought. So they are looking at two different things. So this doesn't affect that. All right. The last question. It says on 13th December, Just Engineering decided to close a factory. The closure will lead to 100 redundancies at a significant cost to the company. At December, no news of this plan had been communicated to the workforce. Will the company recognize the provision? Okay. Who is going to attempt this last one? Are we going to recognize the provision?
Well, just try to do this last one. Can you hear me, sir?
Yes, I can hear you, Uche.
I would say that just engineering will not recognize it because as at 31st December, there was no news to plan yet. To me, there's no obligation.
That's correct. So the company cannot recognize a provision because there is no present obligation arising from past events. This is demonstrated from the fact that the company has not communicated its plans to the affected workforce. So, yes, they want to close factory, they want to send people away, but they have not mentioned it, which means that they can change their mind. There is no obligation whatsoever. It's just something they are still thinking about. So they can't recognize the provision right now because where is the obligating events? We can't see any obligation here, as it were. Okay, so all of this we are solving is just for you to get used to this, especially this, your ability to identify an obligating event. It's just for you to get used to that. Okay, come in, just give me 1 minute. Okay, any questions? Do we have any questions? Okay, so let's go to measurements. Measurement of provisions. Measurements of provisions. So provision can be measured at the best estimates, of the future expenditure required to settle the obligation. You see, measurement of provision is a very sensitive area in reporting. At your level, in your exams, most of your questions that I've seen are very simple and straightforward. Sincerely, I've not really seen anything out of the ordinary for you guys. But when you get to a professional, we'll still teach you this topic. And I think at that level, I've seen some very good questions, which I'll also show you here, just for you to, in case they decide to ask questions from that from that. So here, in terms of measurement of provision, because if you remember the definition of provision, we said is a liability of uncertain timing and amount, meaning that the amounts we don't know. So now we want to find a way to measure it in our books. Now, to measure it in our books, we are saying that you should measure it at the best estimates of the future expenditure required to settle the obligation. Then the major challenge we have is what is best estimate? How do you determine best estimate? And it's a loophole, yeah, because it means that we are leaving it to the judgment of the management to determine what best estimate is. But it gives some guidance. Let's look at it. He said the best estimates should be based on the judgments of the management supported by past experience of similar transactions. So we are saying that, yes, use your best estimate to determine this future expenditure, that this best estimate should be based on your judgments. Okay, use your judgment to determine this best estimate, and you should support that with any experience you have of a similar transaction. That's how you should determine how much you would recognize in your books. So it is a loophole, and you find organization playing around with this. As there are some companies that will just say they will make some provisions in some years, since we are giving room for them to make estimates like that, make judgments. So I mean, it gives room for creative accounting and window dressing. No doubt around. I think I'm back. Can you hear me, please?
Yes, sir.
Okay. Okay. So, like I was saying, I mean, this is how you measure it. This is what the examiner expects you to put for them, but in practice is much more technical than what you would find in your exam. However, when you're making provisions, right, is either you are going to be having a single event, meaning that let's say you have a court case, right? And you don't know whether you would win or whether you will lose, and you don't know how much you would pay, but you still have to make provision for it anyways. Or maybe you have a customer that is about to go bankrupt, or or you can have multiple events where you give warranties to plenty customers. You give warranty to them that if their product should have any defects, that you're going to correct it. That's a multiple event. So you see, if an entity wants to make a provision on a single event, the amount of provision will be based on the most likely outcome. So if you have just maybe a court case, you just look at, okay, because when you have a court case, it's either you win or you lose. So you just look at, okay, which one is the most likely outcome? So whatever is the costs attached to that, that's the one you will go for. So provision you make is based on the most likely outcome. But if it is a multiple events, the provision will be determined as the expected value. Meaning when you have multiple occurrences that you give a warranty to plenty people, that means anybody can just come and claim defects. So you need to do a kind of probability of those events occurring. Then you multiply it by the likely cost to get an expected value. But if there are multiple events, the provision is based on an expected value. So I will just solve 2 questions for you today. Then we'll continue from there tomorrow on maybe 3 questions on single events and multiple events. So, Femi, you have not read anything today. Can you please read this one for us?
Okay, good evening, sir.
Hi.
Fine, sir. Traffic Limited has won a contract to provide temporary accommodation for workers involved in construction of a road. The contract involved the erection of accommodation blocks on a public park, and 2 years later, the removal of the block and the reinstatement of the site. Traffic Limited estimates that the task of removing the blocks and reinstating the park to its present condition might be complex or straightforward. If complex, it will result in a cost with a present value of 4 million naira. So, hello, sir.
Hello, Femi.
Okay. Yes, sir.
Were you reading
Hello,
before?
sir. Yes, I was reading.
Oh, I did not hear you. Sorry.
Okay. Okay. So I should
Have you read everything?
traffic. No.
Okay, I read it. Let's hear, please.
Okay. Traffic Limited has won a contract to provide temporary accommodation for workers involved in construction of a road. The construction involved the erection of a accommodation block on a public park, and 2 years later, the removal of the block and the reinstatement of the site. Traffic Limited estimates that the task of removing the blocks and restating the park to its present condition might be complex or straightforward. If complex, it will result in a cost with a present value of 4 million naira. Or if straightforward, it will result in a cost with a present value of 2.6 million naira. The entity estimates that there is a 60% chance of the job being straightforward. Should a provision be recognized? And if so, at what value? Thank you, sir.
Hey, so in this case now, you will see that this company won a contract to provide temporary accommodation for workers in the construction of a road. So the contract involves the erection of accommodation blocks on public park, and 2 years later, removal of the blocks and the restatement of the sites, meaning that after 2 years, you have to remove whatever it is he has erected. You have to remove them. So the company estimates that the task of removing the blocks and restating the park to its present condition might be complex or straightforward. If complex, it will result in a cost with a present value of 4 million. Straightforward, it will result in a cost with a present value of 2.6 million. And the entity estimates there is a 60% chance of the job being straightforward. Should a provision be recognized? And if so, at what value? Okay, so in this scenario now, this company should recognize the provision because there is an obligation. There's an obligating event because he has won a contract. He already won a contract. And part of the contract requires that he needs to remove the blocks and restate the sites. Okay, so there is a provision. So here, a provision should be recognized because there is present obligation as a result of the contract. As a result of a contract. So the obligating event is to remove the blocks of accommodations. Additionally, it is probable that an outflow of resources will be required to settle the obligation, and it can be measured reliably. Now they're asking us at what value. Remember that provision is measured at the best estimates of the future expenditure required to settle the obligation. And since this is a single event, the best estimates will be based on the most likely outcome. And there is a 60% chance that the job will be straightforward. So being straightforward is the most likely outcome. Hence, provision of 2.6 million be recognized. Okay, so see from this question, he has to remove site and all of that. We have to remove those blocks of accommodation, and is complex or straightforward. If it is complex, you will spend 40 million at today's value. If it is straightforward, you will spend 2.6 million. But since there is a 60% chance that it will be straightforward, so that's the most likely outcome. So we're going to recognize provision at 2.6 million. And that's how you go about, you actually go about about solving this. Okay. Do we have any question? Okay, so we're going to stop here for tonight. Let's continue tomorrow. So tomorrow, Sunday, I think I've told you guys before. In fact, we have to make up for that class we missed last week tomorrow. So tomorrow we are going to be having our normal class in the evening and another one after the tax class. I will let you know when it's going to happen, but I know we're going to be having 2 classes tomorrow. So what we want to finish up tomorrow, 2 things. Number 1, I would solve more questions and tell you some facts, some guidance around this standard, IAS 37. And also, we need to put an end to IAS 10, which is events after the reporting date, also tomorrow. So we need to close those gaps tomorrow so that what will be left with before I start group accounts is accounting policies, revenue, and maybe IAS 8 as well. Then I'll quickly teach you group accounts. It should take me like maybe 5 classes. It's a very straightforward topic, and it's also, you mostly find it every diet as an optional question as well, but I think we are moving in the right direction. So do you have any questions so that you can go and get prepared for FM?
So I'd like to be part of the online group chat so I could get access to the video.
Okay. So Mr. Adichungo is the one in charge of that.
Okay.
Mr. Adichungo is in charge of that. He's going to add you up. If he checks that your record is complete, why not? You become a member of our group, our honorable group. All right. See you guys tomorrow. Bye-bye.